Let's get to those top picks. Number one, Canadian Tire.
Yeah, so Canadian Tire, it's a business that a lot of us are familiar with. It's a very familiar brand with a lot of history. So the company is a retailer of tools, automotive, seasonal items, appliances, as well as clothing. And it seems to always be in the mix in terms of, when you're looking for certain items to purchase, Canadian Tire is always an option. What I mean by that is it's a competitor to Home Depot, Home Hardware, even Walmart, and sometimes even the dollar store. Management has done a very good job, however, of trying to move business away from online competition. So competition from those online retailers such as Amazon. And so often if you go into Canadian Tire, you're choosing to buy a slightly bigger ticket item. Perhaps it's some, sports equipment or an appliance, and something that just can't be shipped in the mail. Mm-hmm. The company has pretty impressive profitability. The return on equity is about 18%, which is well above the average for the TSX. It's got a strong balance sheet, so we're comfortable with that. Shares have traded way down if you take a look at the stock price as well, from a recent high of about $215 to its current prices now around $150, $160. And it offers a 4.5% dividend yield. So I think you're going to get some nice capital appreciation there, and you get a nice dividend yield while you wait for it. And this is a company that Canadians continue to visit and to frequent and are customers of.
Okay, we've talked already about this. Let's get past it pretty quickly. TC Energy is a top pick.
Yeah, so TC Energy, it's a very topical name, and maybe that's why we're talking about it a couple of different times today. But, this is a company that provides distribution business for gas and energy. It also, as I said, owns 7 power plants. TC Energy is down because there's a cost overrun on one of their projects. That's a pretty material cost overrun. There was an update on that today. That dropped the stock about 7% today, but there was an initial drop back in November from the first update about this cost overrun. We think that the firm will get through this issue, that it's a tertiary issue, a temporary issue. It trades at 13 times earnings, so that's the same as the market, but yet it offers a 6.5% dividend yield, whereas the Toronto Stock Exchange offers only about a 3.1 or 3.2% dividend yield. So your yield is twice that of the market, and yet you're getting it for the same valuation as the market. And we think there's plenty of room for that stock to appreciate from its current levels today.
And you don't think there's going to be just an overhang until they finally know how much this project is going to cost? Because they've warned there could be another $1 billion plus if it drags on into 2024.
You ask a great question, Andy, and maybe the best way to answer it would be by looking at the stock price. So if somebody can put that back up on the page, what we'll take a look at is in November, they announced that there was going to be a cost overhang. And you can see the stock trading off after November through December. And then as we got into January, we're through the holidays and, people forget. And so the stock started to move ahead again until, guess what happened today? Another announcement on that cost overhang. Stock pulls back. It's a buying opportunity. We have to be very opportunistic. The market continues to give us opportunities to purchase stocks each day. Today, I think, is a good day to pick up some TC Energy.
Brookfield Corporation, BN, and you're talking about, the original corporation prior to the spin-off.
Yes, exactly. And let's be absolutely clear on that. So there's a lot going on with Brookfield. The entire entity, they're high quality companies, and they've really been a big success story over the years. And so today I'm talking about Brookfield Corporation. Now, this used to be called Brookfield Asset Management until December of 2022, at which point it then spun off a division called Brookfield Asset Management, and it renamed itself Brookfield Corporation. So Brookfield Corporation is the parent company, and it owns pieces of each of the different the smaller entities. We like this parent company. We like Brookfield Corporation. It's really focused on compounding capital by investing in high-quality investments. If you take a look at where they're invested, it's predominantly a private equity company with about 50% of their revenues derived from private equity. 15% is from real estate, another 15% from infrastructure, and then the remainder would be from renewables as well. It pays a smaller dividend yield than Brookfield Asset Management, but that's expected. And what we want from this company is we want capital appreciation. They manage over $750 billion in assets under management. So it's truly a global powerhouse. They attract and retain some of the best, brightest, and smartest people in the country. Shares generally trade at a premium multiple as well, and so it's not often that you can pick it up at a bit of a discount. But if you take a look at the stock price, you'll see that shares have traded off, and now is a fairly good time to pick up some shares in Brookfield, which you can put in your portfolio and you can really hold it for the long term. It's a high-quality company.
Right. Why did it come down last year? Was that the impact of rising interest rates?
Predominantly the impact of macroeconomics and rising interest rates, yeah.
Okay.